Hi, good morning. Welcome to my channel. Today is 4th of August 2022. I am Thomasin, PA 2066. I would like to do a presentation related to RPGT. This is on shares. As we all know, RPGT involve the real property, and if you have real property which is in fact owned by a company and the company holding it in fact has shares, the transfer of these shares in a company that holds real property would be subjected to RPGT. There are a lot about this in the more detail which need to be explained. So I think RPGT involving shares, share transfer in a company that holds real estate property, I would like to do a separate video just for this purpose. So this is called RPGT RPC Shares. So RPC means real property company. Let me begin. Hi, welcome to my channel. I am Thomasin, PA 2066. Today is 4th of August 2022. Topic of presentation and discussion is RPC shares. So this is regarding real property gains tax, which is actually affecting the transfer of real property. And if a company holds real property to a amount that is high enough for tangible asset percentage, then it will be attracting the RPGT calculation also for its disposal or transfer of shares. So this topic I in fact wanted to combine with the CKHT forms. So CKHT is Cukai Harta Tanah, and CKHT form, as we've gone through in the earlier videos, also talks about when a person disposed of his property under vendor, the person sell the property to a purchaser, his disposal of property would invite RPGT tax payable, and there is the duty of the lawyer also to alert the purchaser that the amount that is paid, there is a sum to be retained, and these are all in the RPGT Act. Of course, it applies to real estate, I mean real property, as well as shares of company that is named as real property companies. So this discussion today is about RPC, the real property company, shares, how it's been treated by RPGT. Let us begin. So this is the overall earlier slide I actually show on the pie chart, the amount of topics that I go through in Fine Hui series. This was done almost the same time last year when I was in the quarantine for the COVID by entering Sarawak. I went to West Malaysia, came back, and there was a quarantine required 14 days, so I did a 21 chapter. So this topic on RPC shares should be probably under portfolio. I think it's probably under portfolio because it involves the way how you manage your real estate by forming different portfolio, and one of the portfolios can be a company. So if you hold a property by vehicle of a company, which means that the ownership is actually by a company the legal body is Sendirian Berhad, then this way of holding a landed property or a property under real property interpretation, the definition in the law, it requires to understand the transfer of its company share would involve RPGT as well. So this is probably under the topic called portfolio. Also, we went through shelter, we went through care, which is intermediary, we went through the investment part and also the business aspect. So this one you can go back to my other videos, 21 chapters, now almost 29 to 30 chapters for this series of property investing and selling issues. Anyway, the reference that I collected from today's discussion is about Malaysian taxation. Of course, the very respected authors, both are very well respected authors, Dr. Chung and also Dr. Verinder Jit. So these are all books where I started studying for my ICSA taxation paper. So that was 2001. Of course, the left side, Malaysian Taxation Principle and Practice 7th edition. Now already I searched around in the internet, it's 27th edition. So this is a textbook by Dr. Chung, who is an authority in aspect of taxation law. And then the other one is 6th edition, but he has other books, Verinder Taxation, which are probably newer chapters. So anyway, my source of information came from hard copy books as well as searching on LHDN website on the shares in real property company, RPC. This is the source of most accurate, I would say, the most recent updated information. And there are updated information to 2022 especially you check my other video, the CKHT forms. The CKHT forms are updated to 2022. Also, you visit the other video. So anyway, compliance to the RPGT Act for the transfer of RPC shares, I just want to highlight here, the buyer is also required to retain the 3% of the total consideration sum and remit the amount to the Inland Revenue within 60 days after the purchase of such a disposal. So it not only include the disposal of landed property or real property, but it also involves the shares that is in the company which holds the shares which holds the real estate, the real property. So this one you can refer to CKHT3 forms. Inside the CKHT3 forms, the subcategory of what are the types of transactions that you can ask for exemption. So this one in the CKHT2A. So for the person who purchased, you go to CKHT2A. For the person disposing is CKHT 1B. Because 1A is for landed property, 1B is for shares. So I think we would go to the other video to discuss more on those differences. Now we stick back to the topic of RPC, Real Property Company. So this is the CKHT2A I mentioned just now. So you can see I put an arrow, CKHT2A, which includes the person who purchased the share. So CKHT1B is the person who disposed of the share. Then why do they need to have a system for the share so-called of the company to pay RPGT? Because at one time when the law was passed in 1976, the Real Property Gain Tax Act 1976, it did not have this specified para 34 and 34A. So at that time, people would just say, okay, I form a company, and when I buy a property under the company Sandian Berhad, then in order to avoid all these taxes, then I sell the shares. So when you sell the shares, it doesn't get differentiated from selling shares of any other form of so-called derivatives or debenture. So it means to say the thing was under no surveillance. So it went under the radar of the taxation for the real property. So instead of keeping it like that, people use this way of avoiding paying the real property gains. Then the government actually introduced these sections or this tax para 34 and 34A. So the way that they describe it is called anti-avoidance. So this anti-avoidance is seen here as an example where, in order to avoid being taxed for the real property gains when disposing the property, the person, instead of buying it under his individual own name, he forms a company, and instead of selling the property, he just need to transfer the shares of the property. So if I have 2 shares in Sendang Berhad, and then these 2 shares company Sendang Berhad bought a semi-D house, and then whether in the future I dispose of under my name or I dispose of under the company, the treatments are different. In the case of the earlier days before this anti-avoidance law, it was able to escape the radar. I mean, just transfer the share, I sell the shares away, then the share who owning this new ownership of the share will take over the company, and therefore also has a full legal control of the property. So that was in the long time ago, 1988 and before. So imagine you just need to transfer shares without transferring the property ownership, because the shares of a company is now held by a new owner. So there is no transfer of the ownership of the land title, because the land title still shows that it is owned by the same company, Sendang Berhad. So in that sense, it was a loophole. So the government passed the avoidance rule in the historical way. They went through a historical process. In 1976, initially did not have this Para 34 and 34A law. So now we are having this, but before that we go back to history. In 1984, there were different way of taxing the people. So they introduced this cost transfer tax. So this share transfer tax was 2% for all shares. So in that time, it means that any transfer where it involved land-based company, it needed to pay a transfer tax of 2% on all the shares. And this was introduced in 1984. When that was introduced, of course, the amount, not say in a way significantly causes alarming response, but in fact, it was also not fair to those who bought the property and sold it at a loss. So when they sold it at a loss, they still need to pay, because this is on the transfer. It's almost like a stamp duty. And the current state, if you look at share transfer, the stamp duty is payable at 3 ringgit per 1,000 worth of transfer. So that means when a share is 1 ringgit, you transfer 1,000 shares which worth 1,000 ringgit, you pay a stamp duty of 3 ringgit. Of course, this is the stamp duty part, but then compared to the 2% per share for the time, it was also quite significant, but not as high as 30% if you look at the RPGT rate of gain at 30% within 3 years. But anyway, maybe the objection at that time was that even the loss, you don't make money, you still have to pay. So this causes some issues. The eventual happening was the share transfer tax was replaced. So it was repealed in 1988 and replaced by the Schedule 2 of the Act or RPGT Act Schedule 2 Para 34A of the RPGT Act 1976. So if you look at history, in 1976 it did not have this clause, or in the Schedule 2, and it was introduced only in later part, 21st of October 1988, replacing the share transfer tax. Now this real property company term gives rise to our RPC shares. So it's a short form of calling it as RPC shares. So what is Para 34 in the Schedule 2 of RPGT? So this is a screenshot of the Para 34 which actually says transfer of assets to a controlled company. So this also talk about part of it is para 3 sub para 1b. So if you read the para 3 sub para 1b, it says that the transfer of asset between spouse or the transfer of assets are owned by an individual or by his wife or by an individual jointly with his wife or with a connected person to a company, or whether or not resident in Malaysia, which is controlled by the individual, by his wife or by the individual jointly with his wife or with the connected person for a consideration consisting of shares. So here is in fact saying that if you transfer a real estate by your own self or yourself with your wife or yourself with somebody else who is connected in a company, so you give this property to a company. So it says that when the property transfer of asset is to a company, alright, so this is equal to no gain no loss, because section here says transaction in which disposal price is deemed equal to acquisition price. So when a property is being disposed of by somebody or his wife or together his family to a company that is controlled by him, then this transfer means to say a company acquired this property, so no gain no loss. So if the owner bought the property at 1 million and then subsequently transfer this property to his company, his Sendirian Berhad, then this company actually take over the property at no gain no loss. So there is no RPGT involved in this scenario 3.1b. So para 3 sub para 1b. So why is this important in the understanding of 34A? Because the 34A says that eventually, because this property already transferred from the individual ownership to a company ownership, and the company now holds this property, the subsequent transfer of its shares would be subject to RPGT. Also, this part 34A actually governs the rules and how it is calculated, the number of share, how the share is calculated, and involving gains which this property generates for the shares. So for example, just now we were talking about the 1 million sold, okay, transfer not say sold transfer to the company, Sendirian Berhad company. Now this company has 2 shares. So this 2 shares of Sendirian Berhad company, 1 share should be equivalent of worth equivalent of half of the 1 million, 500,000. So if let's say this 500,000 share is subsequently changed hand, sold to party outside the family, maybe sold to a friend, and then again, let's say the 500,000 share sold to a friend at 700,000. So there is a gain of 200,000. So this 200,000 in the law of RPGT need to be interpreted as RPC share gain. And this RPC share gain would attract whatever related time you compare the timing, whether he immediately sold it, then the immediate 1 to 3 years, within 1 to 3 years should be subjected to 30% against tax. So this is an example. Anyway, I will go into more detail later. It can be quite confusing, so if you are not able to catch or not able to appreciate the law, how it is reflected in the discussion later, don't get upset. Probably I would say I am sorry, my interpretation and my presentation may not suit you. way of understanding. So it is my own way of how to present. Maybe you can look for other information elsewhere. So it is a purpose to make it easy to understand, but then to understand and perfect it, you need to go back and do it yourself. So in simple words, what is Para 34A? It actually says that shares of the RPC upon disposal will be regarded as a disposal of real asset or chargeable asset here. So just an example again, the 1 million real property gone to a company which has 2 shares. Each share should be calculated as 500,000, and if it is sold, the share is sold, and it makes money, the disposal of these shares is regarded as a disposal of the real asset, which is the semi house, but it is in the form of share. So despite if one day the company actually sold the real estate, that means the semi house is no more owned by this company, the share itself would still be handled as a RPC share. So later we will see this graphic, maybe put in a graphic manner, how this thing can happen. It can be quite complicating. So in a simple manner, what is a RPC company, which is a real property company? Under the definition, it is a controlled company. It is on or it actually own or is recently owning a property. So the shares also involving if it owns a share in another company which is an RPC company. So the RPC has shares. So just now the case I was saying, the semi house bought by a friend. But now if the RPC is the RPC, so the semi house is bought by another company. So this another company which buys the RPC shares of this company would also be considered as a potential RPC company. So if it owns a certain amount, which is 75%, so you look at part 3, define value of the property or shares in another RPC or both is not less than 75%. So if let's say just now the situation, a 2 ringgit company, 1 million real estate price, bought semi house, and this is the only hard asset, tangible asset, then 100% is actually this property 1 million. So the company actually owns a property which is hard property, hard landed property at 100% ownership. So let's say if the company has other types of property, maybe the company has machinery, has vehicle, or it has other types of stock, maybe stock for sale. When you are doing trading, then you have a lot of buying and selling. So your stock is also considered as hard property, hard asset. So it's called the tangible asset in accounting term. So if all these assets are plus together and the semi house is more than 75% of the total tangible asset, then it fulfills the definition of a real property company. So a real property company, by having to fulfill all these 3 scenario, I would say maybe a lot of time you can say it's only 2. 2, where are the 2? First, it has to be a controlled company. 2, second, it has to be 75% owning the real property over the total tangible asset. So if any one of it is not fulfilled, then it is not a real property company. When it is not a real property company, then it will not be subjected to the treatment of 34A. It will not be subjected to treatment of 34A. So what is real property now? So real property in the sense under section 2 of the RPGT Act, usually in any law statute, section 2 is interpretation. So in the interpretation, it would list out what are the definition. So in the definition of the RPGT Act, section 2 says real property is land, situated within Malaysia. And how to define land? Land is in fact going back to land court, national land court. It means surface of the earth below the surface, building on the land permanently fastened, or vegetation growing on it, as well as land covered with water. So this is a definition borrowed from National Land Court. Inside RPGT Act, the real property here means land. Also, when a company owns a real property and has fulfilled these two requirements, which is one, a control company, two, 75%, then it becomes a real property company and need to subject its share transfer to a RPGT treatment. So what are the other possible assets just now? The tangible assets could be plant and machinery, stock for trading, investment in other company or other types of RPC company, or book debts, debtors, owns other things. So here I borrowed the website screenshot to highlight the two important things. One is the part on the exemption under Para 2 of the Schedule 4. Para 2 of the Schedule 4 of the RPGT-A is granted to individual on the disposable of chargeable asset, so it is not affecting company. Okay, so Schedule 4 is about what? Schedule 4 is about the 10,000 or the 10%, whichever is greater. And this particular exemption, which is able to give it to individual, would never be given to a company. So in the case of RPGT held by a company, selling it in a company will not have the benefit of getting this exemption. Another part is that the disposal of the shares, when it is lost, that means when you are making a loss in the share traded, or so-called somebody asks to buy your share, which is 500,000 per share, but then you are only able to sell to him at 400,000 per share. So in this scenario, the loss of 100,000 cannot be used in the computation of chargeable gain on the disposal of other assets. So in the same company, let's say it has other assets, so the other assets are sold by actual sale, asset sale, cannot be deducted with this loss in the share. So the share is handled as a share, and the asset sale is handled as an asset sale. Asset sale is the company selling the assembly house direct, and then shares through share, sales through shares means the company sells the share instead of the asset. So this part just to be sure. So if it is an individual, then when it dispose of the share, then it is okay. But if it is a company that disposes of its share, then it doesn't enjoy the Para 2 Schedule 4. Another part that you need to highlight here, I need to highlight here, is that tangible assets are not including trademarks, copyrights, and all these things. So if you have a company having this type of intangible assets, goodwill, patent, copyright, and trademark, they are not included in the calculation of the tangible asset. So in such a way of calculating tangible asset, then the company can become a RPC company in a more solid manner, in the sense that, well, a lot of companies who try to save on RPGT tax want to make it not an RPC. So when you are not an RPC, then you will not be subject to the RPC share on the gain when you sell. So when a company inflate or put a high value on its tangible assets, then the real property part of the tangible asset will shrink. So would shrink to less than 75%, and doesn't need to abide to this calculation of the share transfer